Hey folks, welcome to Pro Trader Strategies. My name is Eric Wilkinson and this is Spotting the Trade. I'm going to get you what you need to know before you go, even if it's broken like glasses. We'll get you what you need to know so it's not off to a rough start. All right, so without further ado, before you go, smash that like button. All right, today's a big day for economic data. We talked about this yesterday. We were looking at consumer price index numbers, seeing if they were passing manufacturers are passing inflation off to consumers. It looks like that's starting to happen here, folks. One thing we started seeing with this inflationary numbers is it's outpacing wage growth. So when inflation's outpacing everything else that's able to keep up with it, you are not able to have that strength of the dollar that one would expect going forward. So that's one of the things that we were looking for coming into today, is looking at consumer price index numbers. Well, across the pond in Great Britain, we did get consumer price index, and those numbers are showing that the manufacturer is passing higher prices off to the consumer. CPI coming in at 7%, expected to be 6.7. Core coming in at 5.7, expected to be 5.3. So the producer price input comes in higher, much higher, at 5.2%, expected to be 2%. So that's 3% over what was expected there. That's the inputs. So the producers are paying much higher prices for the inputs. And then are they able to pass that on to the consumer on the outputs, higher prices on the outputs? Well, it comes in at 2%, expected to be 2.1%. So not looking too bad for the manufacturer, because they're able to offset some of those higher prices. But I can tell you, they are not able to offset most of their higher prices for the goods going into these products. So if you have to think about this from a longer term perspective when you're dealing with manufacturing cycles or business cycles, for instance. So let's break it all the way down to, like, say, a landscape company or something like that, or somebody who is bidding for jobs, really a contractor for that matter. What that contractor is doing right now is he is having architects and folks come to him and say, hey, I need you to give me a price to build this building, right? Well, that building might not start for 6-8 months down the road. Well, he's trying to figure out his pricing now. So if you can think about what's happened in the last 6 months to a year with pricing, especially around the products that go into building, all right, we're talking aluminum, copper, polypropylene, PVC. Okay, all of those things are related to all of these pricing increases that we're seeing. A lot of the aluminum and metals are going into batteries. All right, so if you love green and you love mining, you love batteries. That's driving prices for those metals higher. That's making it more expensive for houses and everything else down the line. All the way down to those folks that are, like I said, bidding for jobs. They are bidding 6-8 months out the road. So what they're seeing is price increases on this product over and above what the profit was that they had built in for it. So for instance, if somebody is bidding for a job, they're saying it costs them $1 for a piece of pipe, let's just say, to make math easy, $1 for a piece of pipe. So I bid that into the job, add it up to about $1.30, put in your profit, right? 30% profit margin. Well, so now that pipe, I can get paid $1.30 for it. Dollars my cost, 30% is my profit. But when we were seeing these prices increases, they were exponentially increasing faster than what those profits were baked into the cake. So for instance, what I would charge, or as a landscaper, $1.30 for a piece of pipe, I'm having to pay about $1.56 for that same piece of pipe. So 26% loss, which makes it extremely difficult for these folks to move forward, right? Because they built this big project, they put millions of dollars into it. There's no profit to actually go out there and start another job right away. So that's the big key with these folks that are doing these bidding jobs, is that they use their profits from the current job to purchase raw material and move on to the next job. If they don't make a profit on this job, how do they go out and purchase and catch up? It's very difficult. They can't just increase their prices on the next job to make up for it, increase the profit by 50% to make up for that loss on the last job and continue to have a profit here. That doesn't work because somebody else didn't have that issue and they're bidding it much lower. So those are the problems I'm seeing a lot going on throughout the housing, manufacturing, building. Any of those folks that are having long duration contracts are really struggling right now with these price increases that are exorbitantly, incrementally increasing, and it just makes it really, really tough. Sorry, got a little bit of on a tangent there with pricing, but that is going to be something that really is going to be driving this market going forward. The volatility in it is going to be really based on how these companies are doing, and it's really tough to tell right now because I know these folks are dealing with these pricing fluctuations. That has got to be hurting their bottom lines on the margins. Anyway, with that said, we've got crude oil inventories coming out a little bit later on. I'm expecting to see hopefully a little bit of a build. I'm talking my position really on the economy. I don't want to see that price really start to move too much higher because that will start to hurt. Bonds finding a little bit of a bottom here. Now I've talked about this, more of a dead cat bounce is what I'm looking for. And that's really when we've seen these really fast sell-offs, this would be one dead cat bounce and then free fall. I'm expecting a little bit more of a dead cat bounce right now as folks are looking to cover some trades here. I think that the equities volatility across the board is risk to the downside again, especially after yesterday's market action. Gold following through as its flight to safety gauge is moving higher. That means that folks are starting to get a little bit more nervous about the economy, the equities, and inflation. They're really worried about inflation right now, especially after the economic data that we've been getting on the CPI and consumer price index. Those things are going through the roof. All right, finding a little bit of a bottom here in Bitcoin. Now, like I've said, I'm a bit of a conundrum here because I thought that this was starting to gain some legs here and that we were going to start seeing some strength in this when we see weakness in the equities. And again, a flight to safety. If you are convicted that Bitcoin is the next major currency, then you obviously would have to be thinking that this would be the place to put your money. Now, one thing a lot of folks are talking about is putting their money on the sidelines. I'm not going to really look at the VIX right now, but money on the sidelines right now is a bit of a dangerous game. Putting money in the equities is a bit of a dangerous game. I'm not going to lie. But when you have money as cash, and we're talking about inflation superseding holding cash, you're losing that value of that dollar is going down. That's why we're seeing gold move higher, because folks that want to hold cash usually will put that money as cash into something like gold. It's always kind of working and not just sitting there trying to get 0.25 or 50% or 0.5, 0.5% interest rate overnight. So I with the NASDAQ, we did get a little bit of a bottoming here. A lot of people are going to hold some solace in finding a bottom on Fibonacci here. Follow through is going to be super important today. We've been breaking these patterns where this was a bottoming pattern. It did not get confirmed. Again, we're getting a bottoming pattern, but not confirmed. I usually will get involved on some of these setup, like yesterday's setup, to get involved in today, but there has not been any follow through. So I'm not going to do it until we start seeing some real confirmations happening. Dow Jones Industrial Average hanging out very close to the point of control. Really nothing to see here. Yes, we've been having a lot of moves. And of course, folks, the mainstream media is going to be blowing this up like it is all these major volatility moves and everything else. But folks, we're just kind of getting settled down right back in and around the points of control here in the equities, which is where folks have found value. That's where we've all transacted. That's where this market's going to calm down. So again, when we're talking about risk in the markets, let's talk about this with crude oil. I'd say crude oil's risk is to the upside, despite the fact that I want it to go down. Gold risk is to the upside. Bitcoin, I'm not gonna play that game right now until we start seeing some real follow through. Same with the equities. But what I would suggest anyway, with the volatility spikes that we've been seeing, we're at elevated levels from historical terms, if you will. This is the opportunity to start looking at covered calls, selling puts for options, or selling puts in these options of stock that you would like to buy. All right. That's your mentality going into all of this volatility. Is you don't love anything. You just want to add a couple of things to your portfolio. If they're going to give it to you, that's selling your puts on any type of pullback. We've had some pullbacks here. I don't know if I would necessarily jump on board with the tech sector here, but I would be looking at things like the blue chip stocks for this type of trade. selling puts and opportunities that I want to add to my portfolio. And then immediately, if you get put those stock, throw in the covered calls, lower overall basis. Should be throwing those covered calls on any stock you have right now on any rip. Sell the rips, buy the dips. All right. That's the game plan right now. Risk to the downside, I would say, still in equities, as really our markets are being driven by geopolitical fodder. So whatever's being said today is really what's going to be driving the markets. I do not expect that we're going to really see the crude oil inventories drive this market unless it is massively out of whack. And right now they're expecting a 1 million barrel build. So what I would say massively out of whack would be probably closer to a 6-7 million barrel build, or on the flip side, probably a 5-6 million barrel draw. So those are the things that would be driving that market as of today. That's about it. All right, guys. Thank you guys all for sticking around. Before you go, make sure you please smash that like button for me. I do appreciate that. Comment if you have any questions. I'll circle back around. And don't forget to hit the subscribe button with the bell. The bell tells you when I'm unannounced. All right? That's all I got, folks. Thanks for joining. If you can't take that on a miss, let's see if I can do this one. No, that doesn't work. All right. Take care, guys. Everything's broken.